Hello and welcome back to In Studio. Today we're looking at something really crucial in microfinance, credit life insurance. It might sound a bit technical, maybe, but it's fundamental for protecting vulnerable borrowers and the institutions that serve them.
Absolutely. It's a cornerstone, really, of responsible lending in this space. And today, our goal is to unpack it, how it works, the benefits, the challenges, and importantly, how technology, like platforms Max Money uses, is making it much more manageable.
Right, because it's often overlooked, isn't it?
Yeah.
But it has such a big impact. So let's start with the basics. What exactly is credit life insurance in this context?
Sure. At its heart, it's a debt cancellation product. Essentially, if a specific event happens, usually the borrower's death or permanent disability, the insurance pays off the remaining loan balance.
Okay, so it settles the debt directly.
Exactly. Sometimes it might cover job loss too, but the core is protecting that outstanding loan amount.
And I've heard it described as decreasing balance cover. How does that work?
Yeah, that's typical. The amount of the insurance coverage matches the outstanding loan balance. So as you repay the loan, the balance goes down, and the insurance cover reduces right along with it.
Ah, okay. So the premium likely decreases too.
Generally, yes. Premiums are often bundled with the loan installment and reduce over time. It keeps the cost proportional to the actual risk, which is efficient for everyone.
Makes sense. And what of the scope? Death and disability seem standard, but are there other things often included, like riders?
Yes, disability is common. You might also see riders for temporary retrenchment, or sometimes even limited funeral benefits added on. Think about the immediate costs a family faces. A small funeral payout can be a huge help.
A really practical addition. And when does the cover typically start and end?
Usually it kicks in right when the loan is disbursed, protection from day one, and it ends when the loan is fully paid off, or if it's settled early for some reason.
Okay, so the mechanics are clear, but let's talk about why this is so vital in microfinance specifically. It's more than just lender protection, right?
Oh, absolutely. It's what we call dual protection. For the borrower's family, it's a crucial safety net. If the main earner passes away, it prevents that debt from becoming a sudden, crushing burden, potentially stopping them from losing assets or falling deeper into poverty.
The huge relief for the family during a terrible time.
Exactly. And for the lender, yes, it mitigates their risk of loan losses, but that risk mitigation is actually what enables them to lend in the first place.
Right. It gives them the confidence to serve higher-risk clients.
Precisely. It allows them to reach lower income segments, people often excluded from mainstream banking, so it directly supports financial inclusion.
And you mentioned trust earlier. How does that play in?
Well, for many microfinance clients, this might be their very first experience with any kind of insurance. If it's handled transparently, explained clearly, and works when needed, it builds immense trust. Trust in the lender and trust in financial products generally.
That's a really important long-term benefit.
Mm-hmm.
Now, MFIs sometimes offer other things like funeral cover on its own. How does credit life stand out?
While things like standalone funeral cover or hospital cash exist, credit life is often the dominant product linked to loans. Because it directly secures the loan asset for the lender, it's foundational. It provides that immediate security for the lender and immediate relief for the borrower's dependents regarding that specific debt.
Got it. So if we were to list the key benefits.
Okay, number one, it enables lending to underserved, higher-risk groups. Big financial inclusion driver. Two, huge peace of mind for borrowers and their families. That's invaluable. Three, it builds client loyalty, especially if claims are handled well. And four, it can provide a modest ethical revenue stream for the MFI through commissions.
This is like a win-win, but I imagine there are pitfalls, things to watch out for.
Definitely. It has to be managed responsibly. One big risk is poor transparency. If the product isn't explained well, clients might not understand what they're paying for or what's covered. That erodes trust completely if a claim is later denied.
So clear communication is not negotiable. What else?
Cost is another one. If distribution costs or commissions are too high, the premium becomes unaffordable or poor value for the borrower.
Right, it has to be fair value.
And then there's the risk of encouraging over-indebtedness. Lenders can't just rely on the insurance. They still need robust affordability checks for the loan itself. Insurance shouldn't mask irresponsible lending.
Good point. And what about regulators? Are they watching this space?
Oh, yes, very closely. In places like South Africa, for example, consumer credit laws heavily regulate credit insurance. They look at pricing, fairness of terms, disclosure, making sure it genuinely benefits the consumer and isn't exploitative. That regulatory pressure really pushes for responsible practices.
Which underlines the need for careful design and management. Okay, this feels like a good point to pause. We'll be right back with more on credit life insurance, specifically looking at how technology like Max Money is streamlining things right here on In Studio.
Here's a question. What powers South Africa's microfinanciers through life's storms? The answer is, of course, Aspis. With 90 years of rock-solid experience, our credit life insurance tackles death, disability, and retrenchment, clearing debts, easing family burdens, and boosting your microfinance business across sub-Saharan Africa. Aspis is compliant and client-focused, and proud ecosystem collaborators with Mycomax. Unlock unbeatable protection with Aspis. Dare to dream bigger. Connect with us at aspis.co.za today.
Welcome back to In Studio. We've been discussing the importance and challenges of credit life insurance and microfinance. Before the break, we touched on the risks, but now let's look at the solutions. How are modern software platforms really changing the game here?
Technology is making a massive difference. Platforms designed for loan management, like Max Money, essentially make handling credit protection scalable and much lower friction for microfinanciers. What used to be a very manual, paper-heavy, error-prone process can now be automated and integrated right into the loan system.
Okay, so it becomes part of the normal workflow.
Sure.
How does that integration work practically?
Well, the insurance options can be configured directly within the loan origination process. When a loan is created, the system automatically calculates the premium based on the loan details and the chosen cover. All the policy data, the premiums due, the insured amount, it's all tracked automatically against that loan record.
So it drastically cuts down on admin and potential mistakes.
Exactly. Less paperwork, less manual data entry, fewer errors. It frees up staff to actually talk to clients, not shuffle papers. And it ensures consistency and accuracy.
And what about the most critical part when a claim actually needs to be made? How does technology help then?
This is where it can be incredibly impactful, especially for the family involved. Having everything centralized means claims documentation can be managed and tracked efficiently within the system. This speeds up the settlement process significantly.
Which must make a huge difference during a difficult time.
A massive difference. A faster, more transparent claims process reduces stress for the family and builds that trust we talked about. Plus, for the lender, the system provides clear audit trails, which is essential for compliance and reporting back to regulators or insurers.
So the takeaway is, technology turns credit protection from this awkward add-on into a smooth, automated, compliant part of the loan itself.
Precisely. It becomes an integrated feature, not an administrative burden.
No, I understand it's not just about the software itself, but also about partnerships, an ecosystem approach.
Yes, that's a key part of the strategy for platforms like Max Money. They partner with established insurance companies and brokers who specialize in this area. Think of names like Aspis, Kepler, Universal, DC Credit Protect. Groups are us in the South African context, for instance. This ecosystem allows microfinance institutions using the platform to easily access credit life products that are specifically designed and priced for the microfinance market. It also makes it easier to offer those complementary riders like funeral or disability cover in a compliant and administratively efficient way. It brings expertise together.
That makes a lot of sense, leveraging specialized partners through the platform. So for lenders listening, what are the key practical takeaways, best practices for managing credit life?
Okay, a few key things. First, simplicity. Keep the product design straightforward. Clear triggers, clear premiums, clear claims process, easy to understand.
Absolutely crucial.
Second, full disclosure. Be upfront about the cost, the benefit, and how that benefit amount changes over time with the loan balance. No surprises.
Builds that trust.
Third, automation. Use your loan management software. Automate the calculations, the deductions, the record keeping. It's essential for efficiency and accuracy at scale.
Technology is key.
Fourth, staff training. Make sure your frontline staff can explain the cover and the claims process simply and clearly, without jargon. They need to be comfortable answering questions.
The human touch still matters.
Hugely. Fifth, monitor pricing. Keep an eye on costs and commissions. Ensure the premium remains fair value for your borrowers. And finally, sixth, focus on claims. Make the claims process fast, transparent, and empathetic. That's the moment of truth. A good claims experience is incredibly powerful.
Excellent summary. So wrapping up, credit life insurance isn't just ticking a box. It's a really powerful tool when used correctly.
It really is. When it's designed well, communicated clearly, and integrated efficiently, especially using modern platforms, it does so much. It protects borrowers, it strengthens the lender's portfolio, it drives financial inclusion, and it ultimately enables more responsible lending overall. It turns a potential disaster into something manageable.
A really vital piece of the microfinance puzzle. So here's a final thought for you, our listener. We've seen how blending technology and thoughtful product design with something like credit life insurance can reshape access to finance and build trust. Where else in financial inclusion could we apply this kind of focused innovation and care? What other areas are waiting for this type of transformation? Something to ponder. Thank you so much for sharing your expertise today. It's been incredibly insightful.
It was my pleasure. Thanks for having me.
And thank you for tuning into In Studio. If you want to catch every edition, please do subscribe on Spotify, YouTube, or wherever you get your podcasts. Until next time, goodbye.